In this video, I'll explain mortgage foreclosures. Every year, unfortunately, Americans will lose their homes to their lender for many different reasons. The foreclosure process differs from state to state, and generally today, there are 6 steps or phases to the foreclosure process. Nowadays, most homeowners and even industry real estate professionals don't realize that home mortgages, as we know them today, have only been around since the 1930s. In this video, we'll also talk about government interventions to mortgage delinquencies, as well as the current state of foreclosures and what's going on in America. Hey, welcome back and thanks for watching. And if you're new to our channel, at Sachs Realty, we're dedicated to keeping our audience well informed on anything and everything real estate. So before we start talking about foreclosures in America today, let's take a look back in history as to when Americans first started financing homes. When American settlers back in the late 1700s first started to borrow money to either buy or build a home. Most home loans at that time on average were about 5 years in length and only consisted of interest-only payments. That is until the end of the 5 years. For most, they still owed the entire balance and there was a balloon payment of the full amount at the end of the term. And by the way, if you were interested in buying a home back then, you were required to put at least 50% down. By the 1800s, waves of immigrants were hitting the American shorelines, and this caused a great housing demand and a huge uptick in home mortgages. Fast forwarding to the Great Depression back in 1929, interest-only mortgages were still quite common, and the terms of the loan were still 5 to 6 years in length. These interest-only mortgages created inexpensive payments, leading buyers to purchase homes that they couldn't afford. And because after 5 or 6 short years of owning the home and only paying interest-only payments, their entire borrowed amount was due at the end of the term. And as you can imagine, for most, they did not have the money just 5 or 6 years later to pay off the loan. And by the middle of the Great Depression, around 1933, 40 to 50% of home mortgages were in default. Now, because of the bank's positions at that time, business financing dried up, unemployment rates skyrocketed, and home prices plummeted as many homeowners tried to quickly sell off their homes to satisfy their debt. This caused homelessness for Americans like never before. For many, they were living in their cars if they had them, or in shanties, which were basically homemade shacks. So back in the mid-30s, in 1934, the federal government stepped in to fix the housing crisis and created what we know as the Federal Housing Administration. The FHA was primarily created to make home financing more affordable and to improve housing standards. The FHA's response to make homeownership more affordable was to federally insure home mortgages. This helped lenders to be more confident that they would get their money back should the homeowner default on the loan. The FHA also introduced longer mortgage terms of 20 plus years and significantly lowered the down payment requirements. This response from the FHA would help cut down on mortgage foreclosure rates. In this chart featured on ResearchGate.net, you'll see the percentage of mortgages backed by FHA increased the homeownership rate by 10%. And by the early 1950s, government-backed mortgages exceeded 43% of total home mortgages. You'll also see in this chart that way back then, home mortgage rates were still about 5 to 6%. And now that you have an idea of how home mortgages have progressed over the years, let's talk about the foreclosure process should a homeowner fall behind in their mortgage payments. Then afterwards, we'll talk about what's going on with foreclosures today, as foreclosures have been increasing since the halt of foreclosures due to pandemic-related circumstances by the federal government's mortgage foreclosure moratorium. Now, just as a reminder, guys, I'm not an attorney, a financial advisor, or a mortgage lender. I'm a real estate broker here in Maryland. So please take a moment and read my disclosures in the informational section below. Now, my understanding on mortgage foreclosures is that laws differ from state to state. So for information specific to your state or about your mortgage or your lender, please seek legal advice. On Investorpedia.com, they describe 6 general phases or steps to the mortgage foreclosure process. So generally, foreclosure begins when a borrower misses one payment or fails to uphold their terms of their mortgage document. So phase 1 is just as I had said, payment default. Payment default occurs when a borrower has missed at least one payment. Once a borrower goes 3 months without making a payment, the lender generally sends a demand letter. This states the amount of the delinquency and that the borrower has 30 days to bring their mortgage current. Phase 2 is the notice of default. A notice of default is sent after the 4th month of missed payments, 90 days past due. This public notice gives the borrower 30 days to remedy past due payments before formally starting the foreclosure process. Phase 3 is the notice of trustee sale. Depending on the state, this process for initiating foreclosure is different. There are judicial and non-judicial foreclosures. So the foreclosure process can vary in the length of time that it takes the lender to initiate the actual sale of the property. Phase 4 is the trustee sale. The property is now placed for public auction and will be awarded to the highest bidder who meets all of the requirements. The lender or the firm representing the lender will calculate an opening bid based on the value of the outstanding loan and any liens, unpaid taxes, and costs associated with the sale. Phase 5 is real estate owned, or as we refer in the industry to the acronym REO. If the property is not sold during the public auction, the lender will become the owner and attempt to sell the property through a broker or with the assistance of a real estate owned REO asset manager. And finally, phase 6 is the eviction process. As soon as the auction ends and a new owner is named, the borrowers are issued a notice to vacate if they're still living in the property. This eviction notice demands that any persons living in the house vacate the premises immediately. Now, there could be many options, whereas the borrower could avoid general foreclosure phases, such as the deed in lieu foreclosure. A deed in lieu foreclosure is an instrument where a property owner voluntarily relinquishes ownership to avoid foreclosure. This is typically less damaging than going through a foreclosure. Verify this deed in lieu of foreclosure option to determine if it's a possibility for you in your state or as per your loan documents should you be considering turning in the keys to your home. Again, guys, I am not providing legal or financial advice to you. So now, as promised, let's go ahead and take a look at some current foreclosure data. So to do so, we'll take a look at one of the leading sources of real estate data known as AdamData.com. Their December 8th article titled U.S. Foreclosure Completions Increase Annually by 64% in November of 2022. Now, please keep in mind that real estate data generally lags behind, and this is due to the timeliness of reporting. But this article is considered to be up to date, and I'm sure the trends are increasing as inflation and the overall state of our economy is questioned. The highest foreclosure rates remain Illinois, Delaware, and New Jersey. Nationwide, 1 in every 4,580 housing units had a foreclosure filing in November of 22. States, as I mentioned, with the highest foreclosure rates included Illinois with 1 in every 2,401, Delaware 1 in every 2,736, New Jersey 1 in every 2,916, South Carolina 1 in every 3,195, and Wyoming 1 in every 3,237 housing units had foreclosure filings. Now, guys, this may not seem like large numbers to you, but you have to consider the fact that during the pandemic, while people were unable to make their mortgage payments, the federal government stepped in with their mortgage foreclosure moratorium and basically halted all foreclosures for quite some time. And this, coupled with the fact that mortgage foreclosure completions are up 64% from last year. Lenders have repossessed 3,770 U.S. properties through completed foreclosures, REOs, in November of 2022. This may be down 9% from the month before, but again, up 64% from last year alone. Now, states that had the greatest number of foreclosure starts in November of 22 included California with 2,244 starts, Texas with 2,114, Florida with 1,709, New York with 1,575, and Illinois 1,243 foreclosure starts. Guys, this was in November alone. If you want to see the stats on foreclosure starts in November in your state, I have a link provided in the show notes below. Now, many experts believe so long as job growth remains strong and our jobs are stable, mortgage foreclosures overall should remain low. But my biggest concern is that now that home prices are declining, should these homeowners be required to sell, and they would be forced to sell for less than what they owe on their loan, if they don't have the cash to make up that deficiency, the question is, guys, will turning in their keys of their home be their only option? Thank you so much for watching this video. If you liked it, you can let me know that you did by hitting that thumbs up button. And if you're new to our channel or you just haven't subscribed as of yet, go ahead and hit that subscribe and smash that alert bell. It'll let you know every time we upload real estate content just like this. And if you're in Maryland, we would love to help you directly with your real estate needs. And if you're anywhere else in the country other than Maryland, we can help you find a perfect agent in your city with our amazing broker network. Simply send me an email with your contact information and we'll reach out and we'll find that rockstar agent in your town. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.